The greatest financial revolutions in history never started overnight. They were not announced with great wars, nor did they emerge with headlines that caught the world's attention. On the contrary, the greatest shifts that changed the direction of history began with small developments that most people didn't even notice. Today, we may be witnessing a similar moment. While the world talks about inflation, interest rate decisions, geopolitical crisis, and stock market fluctuations, China is quietly building a new financial infrastructure. The new gold clearing and settlement system established in Hong Kong might look like just a technical financial piece of news at first glance. But history tells us something different, because every time the system in which gold moves has changed, it wasn't just trade that changed. Power balances shifted, empires rose, some collapsed, and the world had to adapt to a new order. So, could what is happening today be the beginning of events that will be remembered in the same way in the future? Is China really trying to reshape the world's financial system around gold? Or is all of this just ordinary economic developments that are being overblown on the internet? To find the answer to this question, we first need to go back thousands of years. Throughout human history, no mineral has carried as much meaning as gold. Gold was not just wealth. It was also the symbol of trust. The amount of gold in a king's treasury did not just show how rich he was. It also indicated the strength of his army, his capacity to control trade routes, and his influence over neighboring states. Today, people accept paper money by trusting a bank or a central bank. Yet, for thousands of years, people did not have to trust any government, because the value of gold did not depend on any government's word. What made it valuable was nature itself. It was scarce and difficult to extract, and wherever you went in the world, people accepted it. That is why gold is considered the first global currency in history. Ancient Egyptian pharaohs adorned their temples with gold. The Persian Empire financed its armies through gold. The Roman Empire did not see gold as just wealth. The salaries of Roman legions were paid in gold and silver coins. As the empire grew, more minerals were needed. New lands were conquered for more minerals. Thus, gold became an invisible force that directed not just the economy, but wars as well. While the apparent cause of many wars in history was different, one of the most important motivations behind the scenes was access to precious metals. Centuries later, Spain took the stage. When Christopher Columbus reached the American continent, what European states dreamed of was not so much discovering new continents as finding gold. Spanish ships transported tons of gold and silver from South America to Europe. For a time, Spain became the richest country in the world. It built massive armadas, expanded its armies, and influenced European politics for decades. However, history had an interesting rule. Just possessing gold was not enough to remain powerful forever, because economic power shifted over time to the countries that used it best. This is exactly where perhaps one of the most important concepts in financial history emerged: financial infrastructure. People often measure wealth by the amount of gold, yet the real power was in being able to control where gold was traded, how it was stored, and by whom its trade was organized. Therefore, financial centers constantly changed throughout history. For a period, Venice was the commercial heart of the world. Then Amsterdam rose. Later, London became the center of global finance. The common point of every change was the same. First, trade routes changed. Then, the flow of money changed. Finally, global power balances completely diverged. In the early 20th century, the world was on the verge of a new transformation, while Europe was crushed under the burden of two great wars. There was another power rising quietly on the other side of the ocean: the United States of America. During World War I and then World War II, European countries began sending their gold to America in large part to cover the costs of the war. As years passed, the world's largest gold reserve began to accumulate in U.S. vaults. When the war ended, a very large portion of the world's gold was now under America's control. This was not just an economic advantage, it was also the greatest financial opportunity in history. By 1944, the war had not yet ended, but everyone had begun to think about how the post-war world would be shaped. Representatives from 44 countries gathered in Bretton Woods, a small town in the U.S. state of New Hampshire. The goal was to establish a new global monetary system. The decisions made at the meeting would affect not just that period, but even the monetary system we use today. Because for the first time, a single country's currency would be placed at the center of the world economy. That currency was the American dollar. The decision made at the end of the Bretton Woods conference was actually quite simple. The rest of the world would peg their currencies to the American dollar. America, on the other hand, committed to providing 1 ounce of gold for every $35. In other words, the world would not trust gold directly, but the dollar supported by gold. This system provided America with an extraordinary advantage, because countries that wanted to engage in international trade no longer had to transport gold. Instead, it was enough for them to use dollars. In a short time, the dollar became the common language of world trade. Oil was sold in dollars, international debts were paid in dollars, and central banks kept their reserves in dollars. For the first time in world history, a single country's currency was placed at the center of the global economy. However, there was a very important condition for this system to survive. The world had to believe that every dollar they held could truly be exchanged for gold. Trust was the foundation of the system. In the early years, this trust was quite strong. America was the world's largest economy in the post-war period. Its industry was growing rapidly, its production was reaching record levels, and it was exporting goods to all corners of the world. The dollar was not just a strong currency, but also a symbol of a strong economy. But as time passed, the balances began to shift. America's expenditures gradually increased. The Korean War, followed by the Vietnam War, cost billions of dollars. During the same period, the government was allocating billions of dollars to major social programs internally. Although the economy continued to grow, the amount of dollars in circulation had begun to increase much faster than the amount of gold in America's vaults. Countries all over the world were accumulating more and more dollars, but they were beginning to question whether these dollars could really be backed by gold. One of the first countries to voice this concern was France. The then president of France, Charles de Gaulle, argued that the dollar provided America with an unfair advantage. According to him, America was able to purchase real goods and services from the rest of the world just by printing paper money. De Gaulle did not think this was sustainable. That is why France loaded the dollars it held onto ships, sent them to America, and demanded physical gold in return. This was not just an economic decision. It was also a symbolic event, showing that the trust in the world financial system was shaken. Following France, other countries also began to make similar demands. America's gold reserves were melting rapidly. Every ounce of gold that left the vaults increased the pressure on the system a little more. A very critical question was now being asked in Washington. What would happen if all countries wanted to convert their dollars into gold at the same time? The answer was quite simple. America did not have enough gold for that. At that very moment, the Bretton Woods system began to collapse. On the evening of August 15, 1971, millions of Americans were in front of their televisions. President Richard Nixon spoke a few sentences in his address to the nation that would change the course of history. The United States of America would no longer convert the dollar into gold. This decision, which was said to be temporary, was actually never reversed. That night, not just an economic policy changed. For nearly 5,000 years, humanity's understanding of money also changed. The world's most important currency was no longer supported by any physical asset. The dollar was no longer gold. It was just a dollar. Many economists say that that day was the beginning of the modern financial era. Because the capacity of central banks to create money was no longer limited by gold reserves, governments could borrow more, and central banks could provide unlimited liquidity to the market when needed. In the following years, the world economy grew more than ever before. Global trade multiplied, financial markets reached massive proportions, and the dollar, despite losing its gold backing, managed to remain the world's reserve currency. But how? Because what kept the system standing was no longer gold, but trust. People continued to trust America's economy, its legal system, its financial institutions, and especially U.S. Treasury bonds. The fact that oil trade was conducted largely through the dollar also strengthened this trust. Thus, the dollar, despite losing its link with gold, maintained its place at the center of the global economy. However, at the other end of the world, a country that did not yet play a large role in the global economy at that time was watching what was happening. Carefully, China. Although it appeared economically weak at the time, it was beginning to form a long-term strategy that could change the world's monetary system in the future. And at the center of this strategy, as it had been for thousands of years, there was gold. In 1978, with the economic reforms initiated by Deng Xiaoping, China began to open its doors to the outside world. Until that date, the country, which was largely based on agriculture and was a closed economy, would become the world's production hub within a few decades. Factories were opened one after another. Millions of people migrated from rural areas to cities, and the Made in China label began to be seen in every corner of the world. While Western companies moved their factories to China due to low production costs, China was accumulating trillions of dollars in foreign exchange reserves with the income generated from exports. In a short time, the country became one of the largest buyers of American Treasury bonds. From the outside, this situation appeared profitable for both sides. America consumed, China produced. America borrowed, China financed this debt. However, decision-makers in Beijing realized an important fact over time. A large part of the wealth they held was tied to another country's monetary system. If the international financial system was built entirely on the dollar, the one who determined the rules of this system would largely be the United States of America. This was not just an economic matter. It was also a matter of geopolitical power. Then, 2008 arrived. The mortgage crisis that started in America turned into a global financial disaster in a short time. The collapse of Lehman Brothers was not just the downfall of an investment bank. The world saw that even the financial system, which had been seen as the most reliable for decades, had serious fragility. Central banks created trillions of dollars of new money. Interest rates were lowered to historically low levels, and governments announced massive bailout packages. Beijing was watching these developments carefully. Chinese officials began to ask themselves this question: if the whole world is dependent on a single monetary system, and that system experiences a serious crisis, how safe will our reserves be? It was exactly from this point on that China's gold policy began to change significantly. The People's Bank of China steadily increased its gold reserves over the years. At the same time, it became one of the world's largest gold producers. A significant portion of the gold mined in the country was kept inside instead of being sent abroad. The Shanghai Gold Exchange was expanded. Access to gold for domestic investors was facilitated, and China began to become one of the most important centers in the world for physical gold trade. But there was an important detail here that most people overlooked. China was not just buying gold. It was also building the entire financial infrastructure around gold, because throughout history, real power was obtained not only by possessing valuable assets, but by controlling the system where those assets were bought and sold. That is why the new gold clearing and settlement system established in Hong Kong draws attention. Although it appears to be a technical development at first glance, clearing systems play an extremely critical role in the financial world. It is one of the fundamental building blocks that ensures a transaction is truly completed. The asset changes hands safely, and international investors trust the system. Hong Kong's new system targets exactly this. The goal is not just to trade more gold. The goal is to establish a gold infrastructure working at international standards in Asia. Besides this, the fact that the system works in connection with the Shanghai Gold Exchange shows that China's long-term plans are not limited to the domestic market. Beijing is adding new links to the financial network it has been building step by step for years. Of course, this does not mean that the dollar will lose its throne tomorrow morning. Today, a large portion of international trade is still conducted through the dollar. A significant portion of global reserves is still held in dollars, and U.S. Treasury bonds continue to be one of the most reliable financial instruments in the world. But history teaches us an important lesson. Great financial transformations start with infrastructure first. People see the change in currencies last. But the first thing that changes is always the system itself. And perhaps these quiet developments we see today are the first signs of a much larger transformation in the future.